In today's oil and gas market, the real story is not the headline price of crude, while global forecasts from the IEA, EIA, and major banks point to a potential surplus in raw barrels for 2026. Refined products like diesel, jet fuel, and gasoline are creating a much tighter and more supportive picture. Non-OPEC Plus production continues to grow, with the United States plateauing near 13.5 million barrels per day, and additional volumes coming from Brazil, Guyana, and Argentina. Yet the refined product dynamics are overriding any headline surplus and establishing a durable floor that protects revenues far more than many investors realize. Refineries around the world are running at high utilization, but new refining capacity additions are lagging significantly behind demand. Crack spreads, the margin refiners earn turning crude into finished products, have settled into an elevated new normal of $8 to $12 per barrel. Diesel and distillate cracks have spiked to their highest levels in over a year in some hubs, driven by geopolitical supply disruptions. Gasoline cracks are normalizing but remain supportive. The result is that refiners can afford to pay more for feedstock when the products they sell are in strong demand. U.S. Gulf Coast refiners are exporting more barrels to fill global gaps, pulling crude demand higher even as inventories build modestly on the crude side. Geopolitical factors are adding a powerful short-term premium. U.S. seizures of Venezuelan tankers, including the Skipper supertanker and approximately 1.8 million barrels of crude since late 2025, along with additional vessels such as the Centuries, Bella 1, and M. Sophia, have disrupted heavy sour crude flows that complex refiners rely on for high diesel and jet yields. Persistent Red Sea and Houthi-related reroutes continue to force tankers around the Cape of Good Hope, adding 10 to 14 days per voyage and increasing bunker fuel demand by roughly 100,000 barrels per day. Russian and Iranian sanctions further limit product exports. Most dramatically, de-escalation in the Middle East following U.S. and Israeli strikes on Iran in late February 2026 has effectively closed much of the Strait of Hormuz, through which nearly 20% of global oil flows. The IEA's March 2026 oil market report projects global oil supply plunging by 8 million barrels per day in March alone. The largest disruption in history, OPEC Plus is managing production cuts strategically and has paused further increases into the first quarter. While the IEA flags up to 8 million barrels per day of temporary supply losses on the infrastructure side, the picture is equally supportive of stability. Global refining capacity additions are delayed 1 to 2 years or more in many cases, with major projects such as Dangote, Dos Bocas, and several Middle East expansions running behind schedule. New refineries and conversions typically require 3 to 5+ years from final investment decision to full commercial operation. Storage is currently heavy with crude, but finished products remain scarce. This product scarcity paradox means that even if crude inventories build modestly, refiners must keep buying barrels to meet demand for the products the world actually consumes. Higher oil prices and a more precarious global economic outlook have already begun to moderate demand growth, with the IEA revising 2026 global oil consumption growth downward to 640,000 barrels per day year over year. Seasonal patterns add further tailwinds. Summer driving season and winter distillate demand will coincide with these supply and refining dynamics through the second half of 2026. Brent crude base case projections from major forecasters now center in the $55 to $70 range for the year. But product-driven support and geopolitical buffers make a crash below $50 to $55. Highly unlikely, at $60 per barrel, cash flows from conventional assets remain robust. At $90 to $100, levels still very achievable given sustained crack spreads and ongoing disruptions. Returns become exceptionally attractive. The market is not collapsing because refiners need barrels to produce the products the world continues to burn. And infrastructure rebuilds cannot happen overnight. This environment rewards operators and investors who own already developed, Low-cost conventional assets. Major producers are in capital discipline mode, prioritizing returns over growth and avoiding new drill capital expenditures. Production from existing wells can ramp immediately with minimal additional spend, delivering cash flow in a market that values de-risked. Long-life barrels, stack pay opportunities, and behind-pipe reserves in mature basins provide upside without the risk or expensive greenfield development. Fixed operating costs stay low, and net revenues are protected by the refined product floor that persists even if headline crude softens temporarily, taken together. The combination of refined product scarcity, geopolitical frictions, lagging infrastructure, and strategic production management creates one of the most compelling setups the oil industry has seen in decades. Crude surpluses may appear on paper, but the real-world mechanics of refining, shipping, and geopolitics are delivering a price floor and margin support that reward ownership of proven producing assets. Seasonal demand, emergency stock releases, and long lead times for new supply mean this tightness is structural and not fleeting. For anyone positioned in conventional oil and gas today, this is not just a favorable cycle. It is arguably the greatest time in history to buy into oil. The market is rewarding those who own barrels that can flow today at low cost in a world that still demands the products only oil can reliably deliver.